Well, it's interesting. A lot of our conversations have been about interest rates and inflation, and especially around the idea that they have an enormous amount of cash. A lot of them do. And so we're telling them right now, that bonds are back. Not all bonds, but certain bonds, and definitely municipals in the United States, 7 to 10 years are yielding nearly 3%, almost as much as treasuries are, and tax-free. We're also advising them to be in certain parts of the market where dividends are going to continue to be paid and are going to grow. Areas like pharmaceuticals, which have never had revenue declines, even if we do have a recession. And so we're giving them a lot of very specific direction as to where to put money to work. And also, of course, not to market time, because it's very tempting when you've had 8 out of the last 10 years, the S&P has generated positive returns. People haven't seen, a major turnaround in markets. And again, it's very hard to pick bottoms. But I think, that's really what we're talking about, is what's in the portfolio and how to actually make money, as some of these stocks go on sale.
David, you're right. It's hard to pick bottoms. But when you are talking about the NASDAQ down by almost 25%, the Dow off by more than 12% maybe, and the S&P down by more than 15%, if you're a long-term investor, you probably look at that and say, OK, these prices are a lot more reasonable and a lot more rational than they were in the very distant past. And maybe if I'm a long-term investor, it's the right way to do it. I get you don't pick bottoms. Are you giving more conservative advice just because people are so nervous and you want them to be able to sleep at night?
Well, I think that part of sleeping at night, Becky, is looking at just some of the data you just talked about. The last 3 years, for the NASDAQ have been plus 35 in 2019, plus 44% in 2020, plus 21% last year. Now, as you said, we're down about 25%. And you think about it, some of the companies that you really want to own that are cash flow generative and that have 20+% growth rates right now in areas, for example, like fintech and cybersecurity, are things that we think should be added to portfolios at levels at or near where we are. And that's because we have a 5-year view on how to build wealth, not a 1 day or 1 month view. And I think what we're seeing now for the first time is actually some people starting to buy a lot of where certain of these stocks are. And so I think we're getting to the point now where we're maybe 5% or 10% at most away from a place where we're going to actually add more to our equity overweight rather than take it away.